Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with a wrap up of all the events that took place in Q2 of 2025. It was a very busy quarter, so we want to wrap up some of those items with you today. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. First of all, we hope to see many of you. We're expecting over 100 in attendance here in just a couple of weeks at our quarterly investment forum at Perry's near our office. If you haven't already registered, please do so. We also want to wish our clients and their families a very happy 4th of July as the U.S. begins its 250th birthday year this year. So the quarter that started with tariffs, which were the elephant in the room in early April, the markets did respond in a violent way, April 2 to 4, down 10%. And then after a pause was announced a week later, markets went up the same 10%. And all of this resulted in a market that almost went into a bear market phase, which is a 20% decline. We got to a 19% decline from a prior high within this year. And then we ended the quarter, if that wasn't enough, with elevated geopolitical risk, including our own involvement about 10 days ago in the Middle East. So what's fascinating about all of those time frames is if you fell asleep in late March and woke up today, you'd wonder what happened, because as we closed the quarter, the S&P hit 6,200 for the first time, an all-time high. So you may be thinking what Ron Burgundy is thinking here, which is that doesn't make any sense. And in some ways it doesn't. But a couple of things, among others, to always consider is that we never know what the market has priced in. So at the beginning of the so-called 12-day war in the Middle East, were markets pricing in a worse outcome such that a better one was supportive of market prices? And then we also never know what other factors markets are responding to. Markets are leading or forward indicators, so they're looking to beyond the current moment to what may be happening 3, 6, 9, 12 months from now. So while a quarter that started with elevated risk based on tariffs and ended with a war in the Middle East and our involvement with it about 10 days ago, and also ended with the markets, ending at all-time highs, may not make a lot of sense. But again, we never know at least these two things as it relates to markets, what the markets are priced in and what other factors the markets are responding to. Some other things that we're kind of following as we start the second half of 2025, inflation came in closer to 2%, so we're nearing the Fed's target, 2.8 when you exclude food and energy. The Fed continues to be in pause mode after raising rates 11 times, cutting at the end of 2024. The Fed has made no decision yet this year, although the increasing odds of either a July or September cut. Again, the most recent decision, which was a non-decision in June, the Fed stayed where they were. Although a Fed governor made some news the day after the most recent Fed meeting, saying that this Fed governor thought that it was right to start cutting in July. So that's something that the markets are carefully following. The final read on Q1 GDP was a negative 0.5 versus an initial negative 0.2. So we did have a quarter of contraction, the first quarter of 2025. However, the Atlanta Fed is predicting, as of end of last week, Q2 GDP growth of 2.9. So that would mean that a recession, which is 2 quarters of negative GDP growth, would be avoided. Again, this is an optimistic view, but again, it's the view of the Atlanta Fed, which prices this on a daily basis. Most recent jobs report, we've already talked about this before, 139,000. We're going to get on July 3rd, the most recent jobs report, and that's expecting 113,000, which would be a little below where May was. So how are consumers feeling? Well, for the first time in 6 months, University of Michigan Sentiment Index was at 60.5, which is the first improvement. So that shows there's some signs of increasing mood among investors. Debt and deficits remain a problem. This is being talked about in Washington now, but we're on pace to run a $2 trillion deficit and spend over $1 trillion in just in debt service alone. So this is something to keep an eye on. And interestingly, connected to that, Moody's downgraded US debt. And what's fascinating about that is rates have come down since 5/21/25 when Moody's downgraded US debt. So instead of selling debt, which would cause rates to go up, this debt was purchased, causing rates to go down. So some headwinds and tailwinds as we look to the second half of 2025. Tariffs and trade tensions, again, that 90-day extension expires 7/9. Inflation, while it's low, still remains in a sticky way above 2%, which is the Fed's target. Higher interest rates remain, deficits remain, and geopolitical risks are kind of all headwinds that could negatively impact markets in the back half of 2025. So, but some tailwinds, things that could go right, technology and AI, deregulation, inflation. This is the other side of inflation, which is it is softening. We do start to get Fed rate cuts, one or two at least in the back half of 2025. And depending on the passage of the bill that's in Congress now, perhaps some tax certainty going into 2026. So none of this replaces contacting us directly to see how all of these things impact you. So please reach out to us. Leave no question unasked. We're here to help. And again, we hope to see many of you in just a couple weeks at our quarterly investment forum. And with that, we'll close. Again, thank you for the trust and confidence that you place in us. We hope you and your families have a great Fourth, and we look forward to seeing many of you at the quarterly investment forum here in just a couple weeks. Be well and take care.